Welcome, everyone. Today I'm joined by Mike Simonsen, the founder and CEO of Altos Research, to talk about inventory as we kick off the spring home buying season. Mike, welcome back to the podcast.
Thank you. Great to be here.
Great to have you on. I know you did a podcast with Diego when I was out, so this is the first time that I've had you on the podcast, so very excited to get to pick your brain today.
Yeah, I'm looking forward to it.
I know that you have a webinar today, actually, that's going to dive into some of these topics even deeper. Listeners, you can find that in the description of this podcast. But what we want to talk about today, what you're going to talk about on the webinar, is the spring home buying season and inventory, which is a huge concern right now to everybody.
Yeah, and it's really the signals that we can already see for the spring home buying season. We started the year coming off the third and fourth quarter of last year, where we expected the market had slowed way down, and buyers were out of the market, like really cold in the third and fourth quarter. And so based on those assumptions, we expected that inventory would be climbing each week because not very many buyers and some spring sellers, and therefore inventory would be climbing each week starting sometime in January, which would be pre-pandemic, would be a totally normal occurrence. But inventory has been falling each week, and pretty consistently and strongly, meaning demand is higher than we expected based on last fall. Demand's higher than we expected, and very few sellers really have any motivation for selling, for unloading their house with a 3% mortgage or lower. It's such a good deal that so fewer sellers and slightly more buyers than expected. And as a result, inventory is still falling. It's now mid-March. It's very rare that inventory would be falling this late in the year. And it looks like we've got a couple more weeks of inventory decline before it starts climbing in April or so.
Yeah, I think the thing that I've learned, looking at your research, listening to your YouTube explanations, and just knowing what you're talking about is that you say, there's no cavalry coming. Like, people are like, where is this inventory going to come? We're heading into spring. What's your take on that? Are we about to be saved somewhere?
I don't see any signals anywhere in the data that says any kind of surge of inventory is coming. If you are bearish, particularly bearish on housing, and think that the economy is tanking and therefore housing is going to have to slow down or turn lower again, if that's your view, you have a view that demand is going to drop and that supply is going to increase. And so some of the hypotheses about where supply might come from would be investors that are panicking. Oh, I'm not getting my rents, and my costs are going up, and or I bought Airbnbs. I have a bunch of Airbnbs, and now all of a sudden I don't have people who want to stay in them. Or it's like I've lost my job and now I can't afford my mortgage. These would be the scenarios, right? So job losses or investors panicking, and those may happen, right? We may get to a point where the economy tanks and things like those contribute to inventory. But as of right now, they have not happened. So people are still well employed in the country, and investors are holding on to their cheap mortgages. And rents had climbed so much over the past few years that we really haven't seen any of those potential places for inventory to come. They simply haven't showed up yet.
Well, where are we? Give us the headline numbers. Where are we this year versus this time last year, or maybe a more normal year before COVID?
Well, so right now there are 412,000 single-family homes available on the market this week, as of Friday. Pre-pandemic, like 2019, there were basically twice that, over 800,000. Earlier in the decade, there would be over 1 million homes on the market right now, and there's 412,000. Last year, of course, was at the peak of the frenzy before we finally turned the corner and came out. And so there were only 248,000 last year at this time. We were buying everything. And so there were few sellers and tons of demand. And so nothing was staying on the market. So we have more than we did last year. We have significantly more, 66% more. But the difference is compressing each week now because inventory is falling now. And by this time last year, mortgage rates were rising, and so demand was slowing already. So the supply had turned the corner and started rising by mid-March, and this year it's still falling. And so that the difference over last year is actually declining each week now.
It's so crazy. I mean, these are such low numbers. I can't believe we were that low last year, but I mean, 400 and something for the whole country is just like, as we're in the middle of March.
As we're in the middle of March, that's right. And so, normally you get inventory would bottom in, January or February. It'd be climbing each week now, and then peak in July, and then start falling back off again in the fall. If inventory, like as it looks now, like it probably turns the corner end of March, early April before it starts climbing, that implies that we may end the year with 500,000 single family homes. Like, so still in our total pandemic range, not getting anywhere back to close to normal. And I had most of my assumptions had been based on the fact that like we must be getting back close to normal. Maybe if like I said, big recession hits, a lot of job losses, maybe some of those things contribute to a bigger increase in inventory the second half of the year, but they're not in the data yet.
So my question is, when inventory gets pushed from the typical seasonality of like, okay, it starts to rise in February and goes through, if it gets pushed to April, say, or the end of March, does it then push out on the other side, or is there that hard stop in the summer because people are trying to get in for schools?
During the pandemic, 2020, 21, the end of the year had more demand also. So the end of the year was declining faster. The prices were still going up when normally the year peaks, at June 30th for pricing, and then would start receding. And so during the pandemic, we were buying off seasonality, right? We didn't have to worry about kids in school because we were buying in November, and there were those kind of things that were happening. It's not clear to me. I think what this year looks like is really going to be based on the economy. And we talked about the couple of the risks, but on the other side, if the economy comes in hotter than expected and inflation stays persistent, then what if mortgage rates climb over 8%? And if they climb over 8%, that would be the other side of that coin. That would be the other risk for slowing demand way down again, and like it was last year. And so then you could imagine that inventory would rise later in the year.
That is a horrible scenario, and we hope that doesn't happen. Trini and me, no, 8%. We're seeing a little bit go down since the whole SBV thing. So, I would rather see that trend. Really interesting, though, that you can see, like, there is that it's a seasonality thing. Like these are the patterns of home buying that have been true for decades.
And they're pretty close to the week, right? So we track every home in the country every week. And so you can see it's, June 30. Well, July 4th is a holiday and it goes down and it doesn't come back up after that. It peaks June 30th. And, so it's really close. And so when inventory, is the bottom, the nadir of the curve is delayed from, say, January 15th to March 30th, that's a significant change. And it could be that because we're in a world now where everyone in the country has 3% mortgages or cheaper, that we may be like the pre-pandemic times may never come back. Like that normal may never come back again. I don't have enough of a crystal ball to know whether that is the case. Like, do we just expect that inventory now bottoms in March? Or do we, or does it sometime get back to what we knew as normal before?
Hi, this is Diego Sanchez, COO of HW Media, and I'm joined today by Alex Ilazai, Chief Strategy Officer at United Wholesale Mortgage. Thanks for joining us today, Alex.
Hey, Diego, thanks for having me. Good to be here.
So diving right in, we might be seeing the first glimmers of a rebound in the housing market. How is this playing out in the broker channel?
It's playing out really well, so we're excited about 2023. We see a lot of optimism in the market, just like we in 2022 and leading into Q4, and we're hitting the ground running really fast in 2023 here in Q1. We're excited about this whole year and what's upcoming. We've launched a lot of new products. We continue to see a lot of optimism in the broker channel overall. And obviously, when we're in a purchase market as we're in right now, that's where brokers really thrive in the more complex transactions with buyers and sellers and agents and a lot more going on. Just brokers are the best place for a consumer to get a loan. So we see a lot of them continue to grow and thrive.
Digging in a little more there, most forecasters are seeing rates in the 5s and the 6s for 2023 and 2024, which means we will be in a purchase market for the foreseeable future. Is this good for the broker channel?
Yeah, it's great for the broker channel. Like I just mentioned, just assume a rate's at 6%, right? We have temporary buy down products, just as an example, where you can buy down that product where the first year you're going to pay 4%, second year you're going to pay 5%, third year and beyond you'll pay the 6%. And by that time, hopefully we'll be in a position where you can refi that loan. So really, there's just so much opportunity. To me, the way that we think about it, Diego, is like you're dating the rate, but you're marrying the house, right? So you want to go out there, if you see the house that you like, you see the property you like, you buy it, right? And you worry about hitting that lower rate maybe in a back half of the year or even next year. But again, it's just going to be a short-term thing the way that we think about it. And still, relatively speaking, we're not talking about massive interest rates, right? I mean, the days of the 2s and the 3s that we were experiencing in 2021, that was somewhat of an anomaly. So we expect them to come down a little bit, and all the forecasters and economic indicators are pointing that fashion. But right now, I think we're in a good spot, and brokers are continuing to win. And you can see it in our broker share and everything that we're doing. We're just having an outstanding start to the year.
Yeah, I mean, the broker channel's had a great couple of years of growth. Do you expect that growth to continue in 23?
Yeah, we do. I mean, as you mentioned, in the third quarter, which was the latest quarter, actually fourth quarter, is about 22.5% or so of the market is broker now, which is, I think, at the highest since 2009. So we're continuing to see great trends in the overall growth of the channel. And we expect it to be 33% by 2025-26. Like that's what we're expecting to see the numbers come in at. And a lot of that is being driven by just literally hundreds of retail loan officers that are leaving retail and joining wholesale every single month. So those numbers are continuing to do great. And we're actually seeing, as another example, Diego, at UWM here, we have about 400 to 500 loan officers that come in every single week for Success Track, which is a great opportunity for them to learn, develop, network, and help grow the overall broker channel together. So you're seeing a couple thousand people a month that are coming in, and that was happening in all of last year, right? And all the years, several years before that when we started. But if you think about like the times that we're in, right? Everybody talks about a lot of the negativity, and that's what the usual focus of. But the reality is, people are excited about it. Brokers are excited about it. The market's growing. And at UWM, obviously being 100% wholesale, no other company in the mortgage space is better positioned than we are.
I love seeing the confidence and the leaning in that's happening at UWM. Alex, thanks so much for joining us today and sharing your insights.
Great. Thank you. It's good to spend time with you.
I think that is such a great point. Now, I have an ongoing dispute with Logan Motoshami about whether we are seeing a mortgage rate lockdown, but we're not going to get into that. But what I will say is that the whole idea of a new normal, because the thing that is, people are now, they have these low rates, and that's not going to change next year or the year after that or the year after that. So like, at what point do we say this is the normal?
Right. And is it, it took us a decade to get here with lower and lower inventory every year. More and more people had cheaper mortgages. Those homes made better sense as investments because as my mortgage is cheaper, the revenue is better. Like each home is like, it makes sense to hold two mortgages at 3% rather than selling the first one to buy the second one. So that doubling up occurred, but it took a decade, right? And so does it take a decade of rates at 7-8% before we get those inventory levels back to normal? Like, do they inch up over that time? That's a possibility.
It's going to be really fascinating to see. Well, let's talk about specific markets. I think one of the things that is fascinating about Altos Research, we love this data, and I know that your customers love this data because you can drill down into specific markets by the week. So let me pick your brain a little bit. What are some of the outliers on inventory right now? Like where are we seeing some pretty good inventory around the country?
So almost most of the country, especially the central, northeast, mid-Atlantic, those markets mostly have pandemic crisis low inventory levels. Those are roughly the same levels of supply as they had last year at this time. There are a handful of markets, the ones that boomed the biggest during the pandemic, places like Austin and Phoenix and Boise, the West, mostly the American West. Those markets, inventory climbed most dramatically last year. So there was a lot of like inbound migration buyers, or like people buying from California who you could go and spend $1 million in Austin and not blink. And there were those kinds of buyers, and those stopped, and therefore, but the sellers didn't stop. So the inventory climbed in those. And so they climbed dramatically third and fourth quarter last year. A few of them got to pre-pandemic 2019 levels of inventory. And what's interesting is right now, Austin is of the big metros that I've been watching. Austin is pretty much the only one that has just higher than 2019 inventory levels right now. Phoenix got there, but is declining, for example, right now. So Austin is like maybe one market that is like the most the slowest to pick up the spring recovery, and is still kind of in the slowdown of last year, and probably because it had the most dramatic import of Californians overbidding, and that stopped the most quickly. So that's an interesting one, watching Austin. The other thing that I've noticed is we use the percentage of homes on the market with price reductions as an indicator of demand. So when a house doesn't get an offer, it takes a price cut. And so as the percentage of homes with price cuts climbs, then demand is weakening. And so we could see price reductions climb across the country last year from record low levels to high-ish, not bubble high, but high, across the whole country. And like, it was notable that now has come back down across the country, back into much more normal ranges, right? We have few homes, we have moderate demand, and so the homes are moving and enough that they're priced at the right point where they don't have to do price cuts. So about 30% of the country has had a price cut right now. That's a totally normal range. What we've noticed though is last fall it was Austin and Boise and Salt Lake City and Denver and Phoenix. These were all price reductions. They climbed way up. This spring, it's actually shifted more to Florida. So some of the Western markets recovered a little bit, and the Florida markets are now at the top of the price reductions ranking. The ones with the most price reductions. So Austin is still at the top, but the Florida markets have shifted. So last year was like the Florida markets slowed slower, but now they're catching up, and the Western U.S. markets are a little more volatile, picking up when demand's up and slow down when the demand is slower.
So I feel like Tampa is like the Austin of Florida, right? As far as like what we saw there, maybe not because, Elon Musk isn't moving a factory there, maybe not from that perspective, but it felt like it was on every list I looked at last year. So Tampa specifically, what are you seeing there?
So Tampa, the Central Florida markets, Tampa, Orlando, Jacksonville, all of those markets are the ones that are starting to dominate the price reductions list now, which means that they slowed slower, but they're now catching up to what happened in the West last year. Interestingly, in Florida, Miami is on a different cycle than the rest of of the state. And Miami is very much international money, Latin American money, that kind of stuff, and so driven by different forces. But also was a big booming market during the pandemic, and has not slowed nearly as much as the rest of the state.
That is fascinating. I agree. I feel like Miami is just it's in its own location, its own world, really, in every way.
Yeah, and I was talking with Inez, who is the uh, this year's chair of the Miami Association of Realtors, on my podcast last week, and Inez pointed out that a lot of Miami investment is driven by Central American uncertainty. So, in Argentina right now, suddenly it's 100% inflation. And so money has got to flood out of Argentina and go someplace. And so Miami is, as she put it, as close to the U.S. as you can get and still be in Central America, Latin America.
I love that. So interesting. So Florida. So are there any markets where you're like, wow, these markets actually they have a big shortage of inventory, and maybe in a way that's surprising?
Well, I think that, like I said, the Midwest and Northeast markets are still really at their 2022 lows, maybe just a little bit higher of inventory. Did not see any surge of inventory last year. And you can imagine that's because, in Austin, you've got builders and you've got, sellers selling into, and you've got Californians buying everything. When Californians stop buying everything, the sellers don't stop. Then they trying to hurry to the market. They're like, wow, if I'm going to unload this thing to some Californians, I got to get it out now, right? And so in April, May, June, July last year, they're hurrying as much as they could to get to market. But if you're in Philadelphia, you don't have that dynamic at all. And so all you have are people with like cheap mortgages. And they're like, well, if I'm moving to Florida, I'm just going to keep this one for a rental. And so that never, because it's so cheap to keep it, it never becomes resale. And so then you end up, in Philadelphia and Chicago and places in the Northeast where you don't need to unload it, or you don't want to unload it, and so the inventory is staying super low.
We know that inventory has a direct reflection on home prices, right? It's one of the drivers, right? Supply demand. So what do you think is waiting for us this spring when it comes to home prices?
So home prices are they have adjusted down, from the peak. And when we look at year-over-year pricing in Altos, we're tracking a bunch of different measures of pricing. Here's every home on the market. Here's the median price of every home, but here's also the homes that get listed this week, the cohort of new listings each week, and that's a leading indicator where future sales are going to be. And we track the price of the ones that went into contract this week, the pendings. And so when we look at the pendings and the new listings, those are actually down year over year. So last year was spiking up, prices were spiking up still right now, in mid-March, and they kept going. But so we can see that the places where the new listings are coming and the places where people are buying, they're actually down a fraction year over year. And pretty close to flat, but flat to down. And so, that's how you can see that the headline home prices, things like the Case-Shiller and NAR, some of those numbers, those are going to show down year over year for several months. Like we'll be, you'll be seeing the headlines. They'll be like, home prices are down. But what we can see in the data right now is there's not additional downward pressure on prices for the rest of the year. And we know this because, for example, the price reductions aren't happening. So homes are listed, but they're not taking other price cuts because they're going into contract. They've sort of found that equilibrium. And so what we can see is that we can see that the headlines are still going to report, the closed sales are still going to report down year over year, flat to down, for the next several months. The stuff that closes later in the year, those headlines will be that, like, it's not going to continue to drop from here.
I think this is one of the real advantages of having the kind of data that Altos Research has, which is it doesn't lag. I mean, you're going off last week's what was happening in the market, in different markets, in every market last week.
Yeah, for sure. And not only that, it's what the traditional housing data looks at sales price. This house sold for this much. And that sales data is lagging. It's not even current. So a house is on the market now. If it doesn't get an offer, it takes a price cut in April. Then it gets an offer and it closes in May or June. And then in July or August, you start hearing about that data, right? But we can see right now what's happening, right? We can see right now that the homes don't need price cuts. And we can see right now where the new listings they're pricing lower than last year, but they're not tanking each week. So like all of that signal is already there. And so we can, and so, yeah, that's the value of doing this as opposed to the traditional way, which is like, right now, the most recent Case-Shiller number is like November or something ridiculous. It's like, it's like a generation ago kind of thing. So, but those are going to continue to report negative for a while.
So I think that's really interesting when you talk about the home prices and they're flat. They're sort of flat, a little bit down, but that's flat from last year, right? Or like when you are looking at home price, you're comparing them just to last year?
To last year over year. That's right. Last year at this time. Yeah.
Okay.
And so, for example, the price of the new listings, like all the homes, the 74,000 or whatever homes that came onto the market this week were priced at like $399,000. That's the median price of those homes. Last year was just a hair, $399, $999. Like it's like a fraction higher last year. So if you were listing your home last year, that you were listing at like a little bit, a fraction higher than you are this year across the whole country. And so that's unusual in the time series. Normally it's up, right? In as home prices have been climbing so much over the last decade.
We have, you and I both, anybody who's in this industry, we know, I mean, there are so many people out there going like, oh, housing's about to crash. And, I love the people on social. They're like, something bad's about to happen. And they don't say what it is. And they're like, I'm just telling you, it's bad. Or this is the first thing, but they never go into detail. So it just like preys on people's like general anxiety. It's like, well, yeah, something bad's happening somewhere at some point. But I think that what's interesting to me is like they're down, but those were historically high numbers. So from my perspective, it's not some sort of crash scenario. It's not like, or people who are like, well, I'm just going to wait out the market. I'm not sure you can wait out this market.
Well, yeah. So I think you have a few good points there. One is that people are afraid of economic conditions that may indeed come home to roost, right? Like they may come and hit us. We may have a big recession. We may have big job losses. There are signals that those could be coming. There are signals that, we had bank runs last week. There are signals that there could indeed be more economic turmoil coming. And some people, especially in social media, have real strong opinions that those are coming. And so then they say, well, those are coming, therefore housing, it must tank. And they get mad at me when I say, well, I don't know if recession's coming. Like that's not my expertise. But what I can tell you right now is that it's not tanking. And so, they conflate their conviction that the economy must crater from here with what I'm doing is I'm measuring what's happening now. And I try to say is like, when that happens to housing, I'll report it, and so and it's really tough. And so people have real strong opinions and I don't, I've learned that I don't have, I've learned to have humility on predicting things like inflation and recessions and mortgage rates. Like, I don't know any of that. Right. What I'm doing is like, here's what's happening in the housing market right now.
That's so valuable and it's valuable for real estate agents and mortgage companies trying to plan their spring, trying to plan their summer. Like, how much staff do they have to have? How much staff do they not have to have? What can they think of as far as their volume and what it looks like? And so this is why that sort of almost real-time data, I mean, last week's data that this week is so helpful. So I so appreciate having you on, Mike. I'm going to have you on again regularly so we can update us as we get into more of the spring home buyer market. But thank you so much for being on today.
Always a pleasure, Sarah.